Welcome to the Deep Dive, where we take your source material and, well, cut through the noise to get to what really matters. We're here to help you get informed, fast, maybe find some surprising facts, and give you just enough context. Today, we are taking a deep dive into American International Group, Inc., AIG, and specifically their quarterly financial supplement. This one's for the third quarter of 2017.
Yeah, and this kind of document, it's always pretty dense, right? Packed with financial data, how the different business segments performed, and crucially, AIG's own definitions for how they measure things.
Exactly. So our mission here is to unpack all of that for you. We want to find those key nuggets of knowledge so you get a really clear picture of how AIG was doing in Q3 2017 and, the 9 months leading up to it as well.
We'll hit the overall results, then slice it by their main business lines, touch on geography.
And really zoom in on the big factors that shape those numbers. Okay, let's get into it. Let's maybe kick off with the really big picture stuff, the consolidated financial highlights. When you just look at the top line results for AIG in Q3 17, what's the main headline?
Well, the absolute top line, the net income attributable to AIG, is a pretty significant loss for that quarter, came in at negative $1,739 million.
Wow, okay. Losing over $1.5 billion in just 3 months. That definitely sounds like a major hit. How did that compare to the quarters right before it?
Yeah, it's a really sharp swing. The 2 quarters right before Q2 and Q1 of 2017, they were actually profitable. Q2 made $1,130 million. Q1 made $1,185 million.
So a definite return to loss territory then?
Absolutely, after a couple of decent quarters. Now, if you look back a bit further, Q4 2016 was actually an even bigger loss, over $3 billion. But Q3 2016, the prior year quarter, that was profitable. So Q3 17 wasn't their absolute worst quarter recently, but it definitely broke a positive trend.
And I guess that loss translates directly down to the results per share for investors, right?
Exactly. The net income loss per share was $90.91 for Q3 2017, which is, a dramatic drop from the positive $1.22 and $1.21 they had in Q2 and Q1.
Now, beyond just net income, these big financial companies, they often use different metrics for profitability. I see things like return on equity, ROE in the document. What do those tell us?
They definitely reinforce the picture, but yeah, they offer slightly different lenses. The actual ROE, just the straight JAP number, was negative 9.5% for the quarter.
Okay.
Then they also report adjusted return on equity. That's one of those non-GAAP measures you mentioned.
Yeah.
Basically, it's how management looks at performance, excluding certain things they think are outside the normal run of business. And that was also negative at minus 8.4%.
So both negative, contrasting sharply with the earlier quarters.
Very much so. Q1 and Q2 had positive ROE figures.
But wait, I also see another one here. Normalized return on equity. What's that about?
Right. That's another non-GAAP figure. It often tries to smooth things out even more, maybe taking out bigger one-time items or, swings in investment results.
Yeah.
And that number was actually positive at 6.6% in Q3 17.
Huh. So depending on the filter you use, you get a slightly different story.
Kind of. But the actual and adjusted numbers, they pretty clearly show the negative impact of whatever happened specifically in that quarter. The normalized view suggests maybe the underlying engine wasn't quite as bad, but the headline results were definitely driven by big negative events.
The supplement also tracks leverage, right? Their debt levels compared to capital. Did that shift?
It did, yeah. The ratio, they show total hybrids and financial debt divided by total capital, it increased. Went from 19.6% a year earlier, end of Q3 16, up to 23.1% by the end of Q3 17.
Which means?
It basically indicates AIG was relying a bit more on borrowing relative to its equity base over that year. Could be strategic, could be a sign of pressure, hard to say just from that one number.
And interestingly, while they were taking this big hit in Q3, AIG was also still buying back its own stock, returning capital to shareholders.
They were, yeah. In Q3 2017 alone, they repurchased $275 million worth of common stock. But what's really striking is the 9-month figure leading up to that point.
How much was that?
For the first 9 months of 2017, total repurchases were a massive $6,275 million.
Wow, over $6 billion.
Exactly. That's a huge amount of capital being deployed to buy back shares.
Yeah.
Tells you something about, well, maybe management's view on the long-term value, even with a really rough quarter like Q3. Okay, so now, to really understand where that billion-plus dollar loss actually came from, we got to look inside AIG's structure a bit. They organize things into these operating modules, core and legacy portfolio.
Right, so core is like the main ongoing business, and legacy is the stuff they're trying to wind down or get rid of.
Precisely. Core includes their big active segments, commercial insurance, consumer insurance, and then some other bits they called other operations. The legacy portfolio, yeah, that's businesses mostly in runoff. They're managing the old policies, but not really writing much new business there.
Okay, so let's look at the operating results for these chunks. How did the main core segment do in Q3 2017?
Well, that's where the pain was. The total core segment reported a really substantial pre-tax operating loss, $2,142 million in Q3. So yeah, the main engine of the company was deep in the red that quarter.
And which parts of core were the biggest drag on that?
Oh, unquestionably commercial insurance. That segment alone posted a massive pre-tax operating loss of $2,862 million. Just staggering.
$2.8 billion loss in just commercial.
Yeah, and within commercial, the property and special risks part was hit incredibly hard losses that were over $2.6 billion. Their liability and financial lines business also had a loss, but much smaller, around $257 million.
Okay, so commercial insurance was clearly facing some huge headwinds in Q3. What about the consumer side of the core business?
Ah, now that's a completely different story. In stark contrast, consumer insurance was actually quite profitable. Total consumer insurance reported over $1.1 billion in pre-tax income.
Really?
Yep. All its main subsegments, things like individual retirement, group retirement, life insurance, personal insurance, they were all in the black for the quarter. Although personal insurance profit was noticeably smaller than it had been in, say, Q2.
Okay. And those other operations within core, what about them?
That was a smaller loss, about $96 million in Q3. It's often kind of a catch-all, right, for corporate stuff or maybe smaller bits not easily allocated to the main business lines.
All right, but here's where you say it gets really interesting. The legacy portfolio. This is the part they're meant to be shrinking, running off. How did it perform?
Yeah, this is pretty counterintuitive. The legacy portfolio actually reported a profit of $286 million in pre-tax operating income in Q3 2017.
Seriously, the runoff business made money while the main core business lost billions.
In that specific quarter, yes. The segment they're trying to wind down was profitable, while the core commercial lines were, bleeding red ink.
That's quite a dynamic, and I assume the after-tax numbers show a similar split.
They do, yeah. Total core had an after-tax operating loss of about $251 million in Q3. Legacy portfolio managed an after-tax profit of $244 million, excluding one specific transaction thing.
And the return on equity figures must highlight that too.
Absolutely. Looking at their adjusted return on attributed equity, another non-GAAP metric they use internally, core was deeply negative, minus 11.6%.
No.
Legacy was positive 6.7%. It just clearly shows where the financial stress points were in AIG during that specific period.
Okay, so the billion-dollar question, or maybe the $2 billion question here is why? Why did commercial insurance, and specifically property and special risks, have such a truly monumental loss in Q3 2017? What happened?
Well, the supplement's actually pretty direct about the main drivers. They list them out as noteworthy items. And by far the biggest factor in Q3 17 was catastrophe-related losses.
Ah, okay. Natural disasters, I'm guessing, given the timing. Q3 often has hurricane season.
Exactly right. For just the property and special risks segment, in Q3 17, those cat losses totaled a stunning $2,701 million, $2.7 billion.
Wow.
And if you look across all of AIG's property casualty businesses that report in the supplemental info, the total cat loss number was over $3 billion for the quarter. The document defines these as, big weather or earthquake events plus some man-made things. But yeah, Q3 2017 lines up perfectly with major hurricane activity, Harvey, Irma, Maria. So that is almost certainly the main cause of these huge numbers.
Were there other kinds of big losses too, besides those widespread catastrophes?
Yes, they also break out something called severe losses. These are different from catastrophes. They're large individual losses, over $10 million each, but not tied to a single big event like a hurricane. There were $232 million of those severe losses in property and special risks in Q3, and about $243 million total across the PC businesses. So not nearly as big as the cat losses, but still another chunk of negative news contributing to the overall result.
Okay, so massive natural disaster losses were obviously a huge piece of it. What else was going on that contributed significantly to that deep loss in commercial?
The other really critical factor, and this hit liability and financial lines particularly hard, was something called prior year loss reserve development.
Okay, that sounds technical. What does that mean in plain English?
Yeah, it's technical, but super important for insurers. Think of it like this. Every year, insurers set aside money, they call it reserves, to pay for claims they expect to happen in the future. based on policies they wrote in the past.
Got it. Money for claims that haven't fully emerged or been paid yet.
Exactly. So prior year development happens when they look back at the money they set aside in, say, 2016 or 2015 or even earlier and realize it's not going to be enough to cover all the claims from those years that are still coming in or costing more than they originally thought.
Ah, so they underestimated the cost of old claims.
Right. When those old reserves turn out to be too low, they have to add more money to them now in the current quarter. That's called unfavorable development, and it directly hits earnings in the current period. If by chance the old reserves were too high, that's favorable development and it boosts earnings.
And for AIG in Q3 2017, it was unfavorable, I take it.
Very much so. The liability and financial lines segment saw a really substantial prior year unfavorable development of $760 million just in Q3.
Ouch.
Yeah. Property and special risks also had some unfavorable development, about $77 million. So the total prior year unfavorable hit across all segments was $836 million just in that one quarter. And it was over $900 million for the first 9 months of 2017.
So a huge chunk of the Q3 loss wasn't even from events in Q3, but from having to top up funds for claims from previous years, like a delayed hit from the past.
Exactly. It's like finding out past mistakes or underestimates are catching up with you now.
The document mentions something called an adverse development cover, an ADC. Does that relate to these prior year reserves?
Yes, it does. Specifically related to their legacy PC runoff business, those old discontinued lines. AIG has this agreement with National Indemnity Company, which is part of Berkshire Hathaway.
Buffett's company.
Right. This ADC acts kind of like reinsurance or a hedge, specifically against the risk that those very old claims in the legacy portfolio turn out worse than expected. So it affects how some of that prior year development risk gets shared and reported, helping AIG manage the potential swings from those really old liabilities.
Okay, so we've seen the main operational story, huge cat losses, plus significant hits from prior reserves driving the overall loss, especially in commercial. Let's quickly touch on how that looked geographically and maybe bring in the investment side too. Okay, good idea. So, geographically, where did these losses mainly land? Was it concentrated?
It looks like it, yeah. Looking at the selected geographic results they provide, in Q3 2017, the United States segment reported a pre-tax operating loss of $1,464 million. Big number.
Yeah.
And Europe also had a loss, $411 million.
Actually, which makes sense, right? Given the hurricanes hitting the U.S. and Caribbean and maybe some of the liability reserve issues being concentrated there or in Europe.
Exactly. These geographic numbers seem to line up pretty well with the operational drivers we just talked about.
Were any major regions profitable then?
Yes, Japan actually stood out as a positive spot. It reported pre-tax operating income of $50 million in Q3 2017. So the pain wasn't completely global. It was more focused.
Okay. Now, separate from the insurance side writing policies, paying claims, a huge part of any insurer's business is managing all the money they hold, their investment portfolio. How did AIG's investments do? Did that contribute to the overall Q3 picture?
Absolutely. Investments are crucial. AIG had a massive portfolio, over $321 billion at the end of Q3 2017. Now, the regular income from those investments, like interest and dividends, is usually a fairly steady positive contributor.
What?
But the document also tracks net realized capital gains and losses. This is about what happens when they actually sell investments or if investments lose value permanently. And those results were negative in Q3 2017. They reported a net realized capital loss of $922 million for the quarter.
Nearly another $1 billion hit just from investments.
Yeah, and it was over $1.1 billion in losses on that line for the first 9 months of the year.
What kind of things go into those realized losses?
It can be a mix. Selling stocks or bonds for less than they paid, losses on complex things like derivatives or what they call impairments. That's when they have to write down the value of an asset because they don't think it's going to recover. So yeah, almost $1 billion in investment losses definitely added to the pain from the operational side in Q3. They also mentioned income from alternative investments, things like hedge funds, private equity. That can be more volatile, and often it's reported with a lag, meaning the Q3 number might actually reflect performance from Q2 or earlier. That's another area that can swing results.
And just to circle back quickly, we talked about those non-GAAP measures AIG uses, like adjusted operating income. They use those to try and show a different view, right?
Right. As we touched on, these non-GAAP figures are basically management's attempt to filter the standard GAAP results. They exclude certain items, maybe big investment gains or losses, restructuring costs, the cat losses themselves. Sometimes things they see as unusual are not part of the underlying ongoing business trend.
So it gives you another perspective.
It does. It's important, though, to always understand what they're excluding when you look at those numbers. Sometimes it can genuinely help you see an underlying trend, but other times, especially in a quarter like this, excluding the huge events might obscure the reality of the actual financial impact the company experienced. It's just about using multiple lenses to understand the full picture.
Okay. So let's try and pull this all together. What's the big takeaway from this deep dive into AIG's Q3 2017?
Well, I think it really shows a quarter that was just overwhelmingly defined by major and hopefully relatively infrequent events. Primarily, those enormous catastrophe losses from the hurricanes, and secondarily, that significant need to boost reserves for claims from prior years.
And those two big hits just hammered their commercial insurance segment, didn't they? Which in turn dragged the entire company into a pretty substantial net loss for the quarter.
Exactly. And what's so fascinating, or maybe stark, is seeing that happen even while other parts of AIG were doing okay, or even well. Particularly the consumer insurance business being solidly profitable, and even, bizarrely, the legacy runoff portfolio turning a profit in that same period.
It really does highlight the kind of volatility that's just inherent in the insurance business, doesn't it? Especially for companies with big exposures to property damage from natural disasters and also those long-tail liability risks where figuring out the ultimate cost years later is just a constant challenge.
It absolutely does. And, it also really underscores why digging into the details of these financial reports is so important.
Yeah.
If you just looked at the top line net loss, you'd know it was bad, but you wouldn't know why or where.
Right.
Exploring the segment results, seeing the geographic split, understanding the impact of specific things like catastrophes and that prior year development,
Yeah.
and factoring in the investment side, it gives you a much richer, more nuanced picture of what was really going on inside a complex giant like AIG.
And remembering to understand how they use those non-GAAP measures, too, as alternative views.
Definitely. Understand what they adjust and why. It adds context.
Okay, so here's maybe a final thought for you, the listener, to consider based on all this. Financial results, especially for big insurers like AIG, they're really just a snapshot in time, right? They're influenced by the regular day-to-day business, but also by these unpredictable, sometimes massive events from the past and the present. So how much weight should you really place on a single quarter's results, especially when they're so heavily skewed by things like major hurricanes or big reserve catch-ups that might not happen every quarter? Something to chew on when you're looking at any company's performance over time.